Hello, I'm George Vessey, lead FX and macro strategist at Convera, and today I'll be giving you an overview of our latest global FX outlook report, which is available on our blog page. In the monthly report, we feature the key themes and events which are shaping trends across global financial markets. We provide extended research on FX volatility analysis and FX forecasts, taking a scenario-based approach here, which we think is a more responsible way to safely navigate what can be a highly unpredictable and volatile market. Indeed, just over the past week or so, we've seen measures of volatility across different asset classes spike considerably higher, including a key FX volatility indicator jumping well above its 5-year average, plus the VIX Fear Index of equity volatility that jumped by the most in one day ever and to its third highest peak ever. So some eye-popping turbulence. And as ever, there are numerous catalysts such as the political risk that we've seen from July, the snap French and UK elections, and the withdrawal of Joe Biden from the US presidential race, raising some uncertainty. But more recently, the rising US recession fears, the lackluster corporate earnings we've had, and a huge liquidation of carry trades have rocked markets, which we'll discuss in more detail shortly. But first, some key currency insights to set the theme. The US dollar was lower last month. It was only the second monthly loss of 2024 for the dollar index, which tumbled to its lowest since March. And this came despite the dollar's safe haven appeal. So as this first chart here depicts, the dollar's high growth and high yield advantage came under scrutiny after the weaker macro data from the US sparked a surge in bets that the US Federal Reserve will be forced to cut interest rates more than they were letting on. The euro, that clinched a rare monthly win versus the US dollar in July after the European Central Bank held interest rates steady. The currency pair now lingering in the top end of its year-to-date range, around 109 to 110. And perhaps once the equity market stabilised for a sustained period, we could see the single currency gaining strength against the dollar more profoundly, based on the narrowing policy rate expectations, as you can see on the next chart here. The British pound, that reached one-year highs versus the US dollar in July, breaching 130 briefly as a big Labour Party win removed political uncertainty in the UK, while the strong UK GDP number cast doubt on the Bank of England rate cuts. However, we did see the Bank of England cut interest rates for the first time in 4 years at the beginning of August. And given the pound sensitivity to global risk sentiment as well, it has dipped back under its 5-year average of 128, as you can see on this chart here. And then finally, in the APAC region, the Australian dollar plunged from its 6-month highs against the US dollar due to its high beta nature. But it's the Japanese yen dominating the headlines, stealing the show, having rallied more than 8% in a week to its highest since January versus the US dollar, and it scored its third biggest cumulative monthly appreciation on record versus the Aussie, the US dollar, the euro, and the pound altogether. So what are the key themes that have been driving markets, and what are we keeping our eye on? Well, we have been pointing out the plethora of macro data potentially being market moving and trend changing in the FX space, and that is what's happened. Because of inflation coming down globally from its peak at 9% at the end of 2022 to now 3.4%, we are seeing the likelihood of more easing from central banks. And inflation was the dominant positive or good force driving equities up and allowing emerging market currencies to outperform. And this has basically been the summary of the first half of 2024. And even though the pace of this inflation has slowed and the goods and industrial side of the equation and the trade political tensions as well could complicate the picture, investors are comfortable pricing in more rate cuts from central banks. But a lot has changed recently. What's leading those rate cutting bets? We have seen economic momentum continue to slow in Europe, but most notably, it also has in the US. And we've got these negative recession fears that have overtaken the positive disinflation story as the main driver of markets. And last week was a perfect example of that shift. We had 2 big data misses from the US that scared markets. The ISM PMI survey showed manufacturing contracting by the most this year, and probably the most important employment barometer within this recorded its biggest fall outside of COVID since 2009. And then we had the weak US jobs report last Friday showing employment growth missing expectations and the unexpected rise of the unemployment rate from 4.1% to 4.3%. And investors took all of this as more confirmation that US recession risks remain elevated, and they're pricing in up to 5 rate cuts by the Federal Reserve this year. So markets reacted negatively to this. And it's a reminder really that context matters. Rate cuts can be positive for risk sentiment, for stocks and other assets perceived as risky if they are seen as blunting or heading off an economic downturn. But when a central bank is viewed as cutting rates because it's behind the curve or having already allowed the economy to slide toward or into a recession, investors can get rattled. And that's what we've seen over the past couple of weeks in particular. Also, in the grand scheme of things, it doesn't help that the US election is coming up in just a couple of months. Kamala Harris overtook Trump in betting odds of winning the presidential election, and this has created additional uncertainty and volatility. And that's because, one, markets had already positioned for a Trump win in what was called the Trump trade. So these positions have been partially unwound. And two, because investors are having issues identifying exactly how a potential Harris presidency would look in terms of economic policy in the future. So these are the big themes dominating financial markets and causing a stir in the currency space: macro data, rates, and politics. And markets have been stuck between macro and politics for some time, i.e. what was this favorable move in yields versus the political uncertainty. But as we can see via the US equity volatility index here, we've seen a rapid rise in volatility, and we've witnessed this equity sell-off. And these have now been the driver of lower yields, namely because of this expectation of weaker economic growth ahead. And this is why in the first 2 trading days of August, the probability of the Fed cutting rates by more than 75 basis points this year went from 10% to 95%, as you can see here, basically making all the movements so far this year obsolete. And it's this more dovish Fed profile as a result of these rising recession risks that contributed to this so-called risk-off environment in financial markets recently. And that spread into the currency space. And it's also why we've seen a huge amount of volatility in the likes of the Japanese yen. That strengthened considerably over the last couple of months. In July and August so far, the Japanese yen has strengthened against almost all of its global currency peers that we're tracking, as you can see on this chart. And why is this? Well, if you think a big feature of the gains in risk assets in the first half of this year, that involved what we call a carry trade. And this involves borrowing money at low interest rates. So an example of that would be the Japanese yen, and investing that in high yielding assets. And this can be anything from tech stocks, treasuries, or other currencies with higher interest rates. But right now, what we're seeing is the opposite of that trade, a so-called unwinding of the carry trade. And that's due to numerous reasons: global risk aversion, causing investors to come out of these profitable trades. But also, it's been amplified by the fact the Bank of Japan surprised investors with an interest rate hike last week. So as you can see, Japanese forward points, and that measures the gap in the expectations for interest rates between the 2 different currencies. So in this case, we've got the Japanese yen and the US dollar. That's closed considerably and really quickly over the past couple of weeks. And as a result of that, the yen has appreciated well over 10% from its troughs against the dollar to stage its best ever start to a third quarter against the US currency. And additionally, this whole risk-off mood that we've had, the sharp sell-off in equities as a proxy of that, the worries that the Fed may have waited too long to avoid a US recession, and the mounting tech valuation jitters, all of this has exacerbated this unwinding of the yen carry versus high beta and emerging market currencies. The Mexican peso is one of the biggest underperformers, But even in the major space with the euro, the Australian, Canadian dollars all underperforming as well, at the mercy of the yen's rapid appreciation. But here I picked out the British pound against the Japanese yen, erasing all of its year-to-date gains in just a few weeks, and taking a step back to see just how big this fall has been. As you can see, the pound has suffered its worst 2-week decline versus the yen since the Brexit vote in 2016. So ultimately, all of this really highlights how unpredictable and how volatile FX markets can be. And that's why having a currency plan in place is integral to help mitigate any adverse moves unfolding. And looking ahead, we have already seen some calm restored across financial markets, but the question now is whether spurts of volatility will continue in the future, or perhaps this was just another blip and we're going to revert to more of a risk-on environment for some time. And I suspect it's going to be somewhere between the two extremes. We still do have a high level of implied volatility, meaning big market swings are still likely or still expected until full calm is restored and maintained. But what does this mean for our FX forecast scenarios? Well, looking at the euro-dollar currency pair first here, as you can see, the base case still leans higher. The currency pair actually got a boost from the recent underwhelming US cyclical headlines that triggered that adjustment to a more aggressive Fed easing cycle narrative. And this may be enough for euro-dollar to soon test that 110 mark again. Yet the sustainability of and scale of a rally beyond that, it really depends on improved euro headlines as well, and on a return to a global risk appetite. But other parts of the euro-dollar puzzle have yet to be solved as well, and those include a confirmed improvement in the euro cyclical dynamics, more stable euro politics, and as I mentioned, some relief in global risk sentiment. But in general, the pair has been stuck between that 106.50 level and 109.50 level. But a break above 110 is appearing more likely than a break below 106. How much appreciation is in the pipeline? Again, it depends on the global growth outlook, US politics as well. Those downside risks to the currency pair include the Fed pushing back against the market pricing, especially with the US election looming and the uncertainty around fiscal policy for the future. And then we've got to keep in mind China's weak growth story and the Eurozone disinflation story continuing over the coming months, leading to more aggressive rate cuts potentially by the European Central Bank. And finally, looking at the pound, well, it's outperformed more than 90% of the world's currencies so far this year. Last month, it climbed to its highest against the dollar in around a year, as I mentioned earlier, and to its strongest level against the euro in a couple of years. And the currency was the closest it's ever been to erasing its post-Brexit referendum drop on a trade-weighted basis. So this added to the impetus for currency hedging. I imagine lots of exporters were looking to protect against any additional rises in the pound, while importers looking to stock up on inventory on cheaper prices or buy contracts to lock in an exchange rate at more favorable levels. But as I mentioned earlier, those gains for the pound have receded somewhat. The pound's pro-cyclical nature, its sensitivity to global risk appetite, and of course the Bank of England's decision to cut interest rates have all resulted in the sterling coming under pressure recently. And our bullish sterling view has tired somewhat, and that's because the bullish drivers identified earlier this year are arguably priced in now, and the positioning adjustment from bearish to bullish limits further upside potential in the short term. And it's something to bear in mind. But the Bank of England, of course, isn't alone in cutting interest rates. And of course, the UK economic outlook is improving as well. So although positioning doesn't look favourable, we're not expecting sterling to weaken a considerable amount more. We still may need a new positive trigger, of course, a catalyst, domestic or international, to propel the pound towards its next leg higher. And sustained improved global market risk appetite could be one of those catalysts. Sterling could attempt a healthy run back towards that 130 level against the US dollar. Having said that, it might take a while longer to see this. August is historically, or has historically been, the weakest month for sterling against the US dollar. And it's also the same for other pro-cyclical currencies like the Australian dollar, for example, perhaps due to the premise of the summer lull period, resulting in investors wanting safer bets whilst they go on holiday, away from those pro-cyclical currencies like the pound and the Aussie. But of course, seasonal tendencies aren't gospel by any means. However, they have tracked relatively closely so far this year. So it is important to be aware of them and to use them in conjunction with the fundamental and technical backdrop that we have. Now, if you want to find out more about all of these topics and further details on other currencies and forecast scenarios, then you can read our Global FX Outlook report on Convera's blog page. And you can also, on that blog page, find the rest of our macro and market research, including links to our bi-weekly podcasts to help you keep abreast of the changing trends and dynamics of the market and international payment environment. Best of luck and see you next time.